First, I want to get your take on Jay Powell's comments. Just the tone of it was the Fed seems to be taking a wait-and-see approach. However, we are starting to see a lot of cracks in the economy, the consumer especially stretched right now.
Yeah, I mean, Jay did a very calming kind of speech to talk about sort of like where he sees the economy, where FOMC sees the economy. And I think he has it basically right. I think what people are concerned about is, well, okay, where is the economy going? Not necessarily where it is now. But the Fed is well placed to be able to respond either way, no matter what happens in terms of whether the growth side of the economy is going to slow more than expected or whether the inflation side of the economy is going to not do as well as they hope. So I think monetary policy is well placed. The real concern is sort of where are things going, given the uncertainty around some of the administration policies.
So it's interesting for you to say that the Fed seems well placed as we continue to see, I guess, rising calls or rising fears, I should say, that we may be headed towards a recession. I also want to play a soundbite from the Treasury Secretary on Friday, right here on CNBC, something he said about the consumer, and get your take on it.
Top 10% of Americans are 40 or 50% of consumption, and that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed.
So, Loretta, I want to get your take on that and how concerning is that? And I mean, if we're seeing just 10% of people doing about 50% of the spending, doesn't that put us in an even more precarious position, whether it comes to an economic downturn or a real recession?
Yeah, I'm not sure that's really news, anything new in the economy. That's typically what you see is that the people who are wealthier are going to do more spending, but it's the lower income people, the median income people who actually represent more of the volatility in spending and the growth in spending. So in some sense, you do have to be concerned more about what's going to happen to the lower income people. So again, now we're talking about levels of spending versus growth rates. And I think that's also what people get sort of confused about in terms of when the Fed says tariffs, we could probably look through them. They're one-off changes and they're not inflationary. When people go to the grocery store and they see higher prices, they're concerned about them. So I think partly what's going on is there is a big adjustment in the economy. I think you do have to look at scenarios of what could happen. And we could see the economy slow more than people are expecting. The chaos from DOGE, the uncertainty because of the tariffs, right there, that uncertainty could reduce spending and reduce hiring. And we're already starting to see that when you talk to businesses, they're on a wait and see attitude. And we saw that the last Trump administration, when he put on tariffs, there was a lot of uncertainty around that, and we did see the economy slow. So when you do scenario analyses and what could be happening to the economy going forward, you have to be contemplating that there could be a more market slowdown than you expect. Not my base case, but you have to entertain that might be a possibility. And you have to entertain that there could be the tariffs actually being inflationary this time because of the starting point. The economy already has inflation higher than expected. We're already seeing inflation expectations moving up. If those become a little unstable and keep moving up, we're not going to get to inflation being back to 2% in a near term.
Well, I hate to interrupt you. I know so many of our watchers want to hear your perspective and everything, but I do have to ask you. You said chaos from DOGE, and at the same time, you're saying that the Fed is well positioned. They're well positioned for chaos. I mean, looking at the numbers from Apollo, there's about 3 million federal workers, about 6 million federal contractors. A lot of them could be disrupted. How does the Fed view that as, it continues and we're expecting to see weakness in the jobs report? And they also do their 5-year strategic review. I mean, very quickly, and I hate to rush you, but how can you say we're facing chaos from DOGE and at the same time be well positioned?
Well positioned in terms of being able to react if the economy responds in a different way. So, for example, if it turns out that the economy is, getting weaker than they expect, they can bring rates down. If it turns out that inflation is hanging up more than they want, they're going to have to be a little more staying where they are for longer. And I suspect that might be the right strategy here. You stay where you are until you actually get more evidence that there's a material weakening in the economy. Again, not my base case, but I think you have to be prepared and then be prepared to bring rates down later in the year.